Good evening, everyone. Today we are doing our final project presentation. So the topic we have chosen is portfolio optimization with financial data. So we are a team of four, myself, Shyamanth, and my other teammates are Akhil, Saravana, and Dharanitha. So getting to the introduction, this project involved analyzing financial data from four key assets, Apple, Procter and Gamble, SPN 50, and T-bills over 1 year period. To ensure the data was clean and ready for analysis, several transformations were applied. These included handling missing values. Any gaps in the dataset were addressed to maintain accuracy. And the second one is creating historical frequency plots. These plots provided a visual understanding of asset performance over time. And the third one is conducting preliminary statistic analysis. So the key metrics like mean, variance, and correlation were calculated to get initial insights into data. So building on this prepared dataset, optimization models were developed. The goal was to identify the most efficient assets allocation strategy, providing practical investment advice tailored to different objectives. Going on to the next slide, the literature review. So, what is risk diversification? Risk diversification is crucial in portfolio management. The goal is to bring stability and functionality to the portfolio's value by controlling variance, which means how much returns can deviate from the expected value. This strategy ensures that no single market fluctuation significantly impacts the overall portfolio. And coming to the next one, current approaches. We leverage two prominent methods to achieve effective diversification and robust optimization. This approach addresses parameter uncertainty in simple terms. It ensures the portfolio remains effective even if there's a variation in inputs like asset returns or risk. So, getting to the next one, this method deals with randomness such as market unpredictability and by analyzing multiple possible scenarios to make informed decisions. Why are these important? These methods are increasingly relevant today due to unpredicted markets, as highlighted by Burke and Totally in 2021. They provided a framework for building resilient portfolios that can withstand market volatility and maintain functionality.
Hello everyone, this is Dharanitha. So today I'll be talking about the objective of this project. So the main goal of this project is that to develop an evaluative optimal portfolios using a sophisticated prescriptive analytics. Each portfolio is designed to address a specific investment objectives, ensuring they meet the needs of diverse investors. So coming to the three optimization models that we have used in this uh, for using which will be focused on this project is risk reduction model, which is designed for investors who prioritize minimizing risk and maintain stability. And the next one is return maximization policy, which is targeted at investors seeking high growth essentials. Next one, the last one is sharp ratio optimization model, which aimed at balancing risk and reward to deliver the best risk adjusted returns. These models utilize financial data from assets like Apple, Procter, and Gamble, and SP 500 and T-bills, ensuring a diverse and practical application. The impact was by addressing stability, growth, and balanced returns. These projects provided a tailored solution for every investors, helping them to navigate today's volatile financial markets, used to advance the analytical techniques. So, to summarize, risk diversification strategies, particularly robust optimization and static programming, provided by the foundation for building resilient portfolios. Ultimately, these models help in offering valuable insights for managing risk and maximizing returns and achieve balanced investments. So, coming upon the next one, which is the data sources, the data is used for the project was sourced from Yahoo Finance, as well-known platform for historical financial data. It provides a reliable and comprehensive data sets that frequently used by the researchers and investors for analyzing stock performance and trends. This project focuses on a daily price data for four distinct assets, which is Apple. Apple represents the technology sector, which often categorized by high growth potentials and volatility. Next one is Procter and Gamble. So Procter and Gamble is a good consumer company, which is considered as a defensive stock. Its stability and lower sensitivity to market fluctuations make it essential addition to the portfolio, balancing our riskier assets like Apple. These SP and the next one is the SP 500 index. So it is a market benchmark that tracks the performance of 500 range companies across various sectors. It often uses as a reference point for measuring the performance of other investments and diversifications. Next, the fourth one is T-bills. So the treasury bills or T-bills are the risk-free rate and serve a baseline for comparison. Including T-bills help calculate critical performance metrics such as Sharpen ratio, which evaluates the risk adjustments and returns to a portfolio. In preparing these data sets, the daily price movements for these assets over a 1 year period were collected. This high frequency data provided a detailed review. Thank you.
Descriptions of algorithms used. The optimization process in this project involved three distinct algorithms, each tailored to meet specific portfolio objects. Those are minimizing risk, maximizing return, and Sharpe ratio. The risk minimization model the objective of it is to reduce portfolio volatility by optimizing the allocation of assets to achieve the lowest possible risk. The key approach is focusing on minimizing variance, which represents the portfolio sensitivity to market fluctuations, ideal for risk-aware investors looking for stability in returns. The assets included are to balance low-risk assets like T-bills with other high volatility options like stocks, and the return maximization model, the objective of it is to maximize portfolio returns without explicitly considering the level of risk involved. The key approaches are the allocates assets to achieve the highest growth potential over time and suitable for investors with a high risk tolerance who prioritize growth. The methodology uses historical price trends and returns to predict future performance and maximize growth potential. The Sharpe ratio's objective is to optimize the balance between the risk and return by maximizing the Sharpe ratio. The Sharpe ratio ensures that returns are efficiently earned for each unit of risk taken. The significance is for ideal for investors seeking a balanced strategy that weighs both risk and reward. Highly regarded in financial analytics for assessing portfolio performance. The data visualizations, the summary statistics, and historical trends. Um, it provided a foundational understanding of asset performance before optimization. The visualizations, the line graphs, uh, show historical price movements of the assets. Uh, The line graphs show historical price movements of the assets like Apple, Procter and Gamble, and S&P 500 tables. The frequency plots highlight the distribution of returns over the year, helping to identify trends like consistency or volatility. The correlation heat maps reveal relationships between assets to assist in diversification decisions. The optimization result visualize this, the risk minimization, the pie chart or bar graph of asset ways indicating allocation for minimizing volatility. The return maximization, the comparison of expected returns for this model with other strategies using bar graphs or line charts. This we can see that Sharpe ratio optimization, the scatter plots showcasing the balance of return versus risk for different portfolio allocations. Comparison of Sharpe ratios for the three models to highlight the efficiency of each approach. This performance metrics indicate the portfolio returns, portfolio volatility, the Sharpe ratio, which overall returns achieved by each model, and the level of risk associated with each portfolio, and the efficiency of returns relative to risk for each strategy. And the results comparison we used side by side bar charts to compare the outcomes of all three model across total returns, risk, and Sharpe ratio. Thank you. Now, my friend Saravana will continue.
Hello. So the results from three optimization models were then compared. So the three optimizations are risk minimization model and return maximization model and Sharpe ratio optimization model. So coming to the risk minimization model, it allocates equal weights across assets, achieving the lowest risk but yielding a negative Sharpe ratio, indicating suboptimal risk adjusted returns, which also made it more clear. And coming to the return maximization model. Yeah, coming to the return maximization model, it achieves the highest return but also incurs the highest risk, where making it suitable only for the high risk investors. Now, coming to the Sharpe ratio optimization model, it offers the best balance of risk and return with the highest Sharpe ratio among compared to the three models, and it also despite being slightly negative returns. Coming to the conclusion, after evaluating the three models, the Sharpe ratio optimization model was selected as the final recommendation. This model strikes the best balance between risk and return, making it suitable for a wide open range of investors. From cautious to growth oriented, it leverages diversification and risk adjusted metrics to create a portfolio that adapts to varying market conditions. And it also, however, there are limitations such as reliance on historical data, which may not predict the future market performance, but the future improvement could include integrating machine learning techniques for predictive analytics and expanding the datasets to enhance the robustness and accuracy. Thank you.